Livewire's top-rated fund series. I'm your host, Eley, and today I'm joined by Ben Griffiths from Eley Griffiths Group, who's the Senior PM and co-founder of the business. Thank you so much for joining me.
Pleasure, Eley.
First up, I'd love to know what actually motivates you as an individual. You've been doing this for quite some time, so what keeps you going?
Oh, look, I love the situation where putting the work into my analysis and reviewing the markets on a daily basis, and then placing bets, and then having some winning trades. Not always, but I work towards that. So I think it really is the thrill of pitching my skills and my team's skills against the benchmark and against the market. So it's really that cut and thrust of almost going into battle on a daily basis.
Tell me a little bit more about your background and how you actually developed your investment philosophy.
Well, I've been in this business a long time, as I think you were hinting at in your introduction. And I essentially started as a stockbroker, so I've spent a bit of time on the sell side. After my university studies, I immersed myself in as much financial literature as I could. So I've read up on all the great money managers of our time, and then was able to parlay a beginning in stockbroking into a career in funds management. So essentially hours on the clock, a lot of reading, and I guess I was resigned to the fact that there are no shortcuts in funds management. You've got to put the work in, you've got to do the reading, you've got to form the relationships, and then you've got to learn how to manage money. So that's sort of how it all came about. Time on both sides of the phone, a few hours on the clock, and then a few sort of bouts of market upheaval. And nothing prepares you better than a December 2000 .com collapse or a GFC event, or even the events of March of last year.
Yeah. Are there any people that come to mind as key mentors?
Oh, there's a number of fund managers, many of whom are retired, Australian fund managers, Peter Mowat, Greg Matthews, two local fund managers that were very inspirational for myself. And then internationally, of course, I've read the works, as everyone has, I guess, of Warren Buffett and Charlie Munger. They're inspirational in their own way. Peter Lynch from the famed Fidelity Magellan Fund. His works are incredibly motivational. And Larry Williams, who's a not too well-known technical analyst from many years ago. Larry had a very simple approach to markets and trading markets and reading markets that I really subscribe to. I like the style, so I follow Larry's work, and I think have employed a lot of his principles in how I think about a market on a daily basis.
Let's talk a little bit more about how you're investing right now. What's an investment topic or theme that you and the team are spending a lot of time debating at the moment?
Well, at the moment, I think the big preoccupation for us is for how much longer the value or the cyclical part of the share market can keep going.
How much longer?
Well, that's a good question. That's why we're debating it, I guess, in the office. But that process, it kind of started with gusto just after we had the US presidential result in November, and then 6 days later we had 3 US vaccines announced. That ushered in a recovery in cyclical names or stocks that are bound up in good economic outcomes and economic recovery. So that these particular bouts or these waves of price action tend to do well when you have low interest rates and an accommodative backdrop. We're seeing that right now. How long can it go for? I think one yardstick we're trying to see whether we can apply is the steepening yield curve. The direction of the yield curve is all important. The yield curve at the moment in the United States between the 90-day and 10-year bond is about 260 basis points in round numbers. As that steepens out, I would expect to see continuing interest in cyclical stocks. So it's really all about, as the yield curve steepens, then interest in those stocks should continue.
Where do you think we are in the market cycle right now?
Well, very hard to argue that we are not late in the market cycle. We are at a very mature stage of the market. The market's been rallying very hard out of the March 2009 lows. And of course, we had an important retest in March of last year, which was eagerly bought out, which I'm pleased to report on. So I think we are in a market that is, in the words of Sir John Templeton, we are approaching the euphoric stages of the market. And bearing in mind, of course, pessimism, scepticism, optimism, and of course euphoria. And I think we are moving into the euphoric stage of the market. We've seen it with the level of interest that private clients have got in the market here and internationally. The development of so-called SPACs in the United States, those cash box vehicles, that's a direct outworking of, I think, a highly excitable market and a large liquid pool of untapped household investors. So I think investor interest at that retail level would suggest to us that the market's getting a bit frothy in parts. So whilst we have pockets of euphoria, I think the market can continue to rally in recognition of the earnings recovery and the fact that liquidity remains very supportive. So no correction of any large scale, Eley, being forecast here. But naturally along the way we'll have sell-offs that will restore pricing to more sensible levels, but no major cataclysmic correction is on the horizon from what I can see.
Thank God. What is one key thematic or idea that you think investors have to get right to be successful over the coming decade?
Yeah, that's a very good question, because as much as investors want to buy value and they want to buy stocks they know, they do have to have regard, especially if you've got a longer term perspective, which is what you've asked about. You need to think about a thematic that is yet to play out. And I think the most, for us, and for me as a seasoned investor, the most exciting thematic that is beginning to play out and has a long way to go is the rise and rise and rise of iGaming and e-gaming and esports. And those that phenomena, and we're talking about online betting and gaming, and we're talking about, in the case of the United States, where essentially betting and gambling was essentially prohibited outside the government tote. It was prohibited for 100 years. So you had the passing of legislation there, which is state by state going to open up wagering and gaming across the United States. We've already got a substantial market in global video gaming as well. The global video gaming, we're talking about Nintendo games and Activision Blizzard and Take-Two and those sorts of businesses. That market's already worth something like $31 billion. It looks to me very much like iGaming and esports. That market will dwarf that in size. I think the estimates in the US of iGaming did have the total revenue available to companies of something like 25 to 30 billion. It looks like that pool of potential gambleable dollars, if that's the word, or puntable dollars, is probably closer to $40 billion. So there's an enormous opportunity that goes with this online, the rise and rise of online commerce, that is now associated around gaming and wagering. And in Australia, there's a number of businesses that are involved in that area as well. We're talking about Aristocrat, we're talking about PointsBet, BetMakers, we're talking about PlaySide and Mighty Kingdom, those sorts of names. So they're in their own way also involved in what we think over the next decade will be an enormous uptake and an enormous growth in revenues, clearly, but also participation. And there'll be substantial opportunity there. So we think that's a long-term metric that investors probably need to have a think about.
If you had to pick one of those stocks for investors to back over the long term, what would it be?
Well, that's a very tricky question. They're all highly exciting. I mean, I think for us, PointsBet is doing some very, very clever things in terms of winning its share and its presence in a number of US states. And we think with their credentials and their experience and their model that they'll progressively grow out their footprint across the United States. So probably PointsBet, which we've been an investor in, Eley Griffiths Group's been an investor in PointsBet from quite early on and continues to be an investor. We're very excited about the way in which they're approaching this terrific opportunity.
Are there any long-term investment ideas that you're also backing at the moment? Sure.
Well, outside of that, I just before I came on camera, I was chatting to a fellow fund manager, and for me, one exciting opportunity resides within the infrastructure space. And I think in this miserable environment that we've found ourselves in the last 18 months, airport ownership is something that people would frown upon. The thought of owning an airport right now is something that would not impress people. But out of adversity, of course, comes opportunity. And just locally, you can't look too much further than Sydney Airport. But I think even more exciting for us as an investor is the opportunity that Auckland International Airport in New Zealand operates and offers. It's the third busiest airport in this part of the world after Sydney and Melbourne. It's clear, like all airports, it's reliant on air traffic, but not all of it. It's a successful retailer and a successful property developer. So I think, for my money, a longer term portfolio that should consider airport investment. And I think Auckland International, which does sit in our portfolio, it's a small cap. It's a small cap we've owned for a while. It's very well managed. It's a monopoly operator in New Zealand. If you're going to New Zealand, more or less, you have to go through Auckland. It has a very well considered plan and business model. I guess it just needs the relief that the return to normal air traffic will bring. And for us, longer term, the prospectivity for Auckland International Airport is high and strong. So we remain a committed shareholder and probably have a few more to buy too.
And just finally, I'd like to end on one practical tip and advice for investors so that they can be more successful.
Sure. I think one thing of the many things I've learnt along the way, it was drummed into me at an early age, and it's so true, and that is that in matters of finance and funds management, one's got to be patient. Investors need to be patient. They need to take in some cases, a longer term view. In other cases, when a story is momentarily derailed, you need to hold the line and be patient with the company. If you're backing a business that is well managed, that's conservatively funded and well structured and not overly risky in terms of how it's funding its operations, if you're buying a business or a stock that is exactly that technically, if you look at a chart, looks like it's technically behaving well, that has a sound model and a sound market opportunity, then you should hold it. So it's really the virtues of patience. Very easy to take a quick profit and move on. Very easy to lose patience with a stock because the bloke next door's bought a stock that's doubled in the last week and yours hasn't. I mean, they're natural human inclinations to want to jump off, but you need to be patient and you need to sit and nurse stocks. And who knows, sometimes if you wait long enough, you will get multiples of your money rather than just a quick doubling of your money. So I think the most underestimated attribute for a good investor is patience.
How do they avoid the market noise though?
Oh, well, that's part of the discipline of looking at your stock and being convinced, looking at your company and following it and being convinced of the merits of what it's doing. And if it does soften up and comes off a bit because of normal market reactions, then you've got to buy more. So it just means you've done the work, you just need to sit with them because for me, that's probably the greatest failing of an investor is it's lurching from one idea to the next and moving around, and all you're doing is crystallising small gains that you'll share with the ATO, and also crystallising gains that you'll be paying brokerage on. And so you'll end up paying huge amounts of brokerage and make a huge donation to the Australian Tax Office, and you actually, end of the day, won't go anywhere. So I think patience is key, and it's a much underestimated feature of good investing.
Well, you've shared some fabulous advice with us today. Thank you so much, Ben.
Thanks, Eley. My pleasure.